Hi, I'm Gregory with the Delia Group, and today we're going to discuss a little bit about interest rates and how they affect your purchase. Currently, the mortgage interest rates have been hovering around 6.5% to 7%. We've been waiting for rates to drop, and the mortgage lenders have been saying they are going to drop for the last 2 years. However, the mortgage rates closely follow the 10-year Treasury note. And so it's been hanging up in the high sixes, around 7%. How that affects your mortgage is your monthly payment. For each percent of mortgage at $400,000, it's roughly about $200 a month in your payment. It's important not to be overly focused on just the rate when you're purchasing your home, because many people think this is your biggest investment. If you're purchasing it with a mortgage, you should really be focusing on a few other things. You should be focusing that you're in a home that you like, in an area that you like, with a payment that you can afford. Those are the three most important things when you're purchasing a home to live in. If you were purchasing an investment property, the number very different on how the mortgage rate would affect your profits and loss, and that might have a more impact on if you should buy the property or not. But when you're looking for your primary residence and where you want to live your life, those are the three most important things. There should be relief coming in the next year or so, according to the three top aggregators from the mortgage people that have a lot more knowledge than I do. So we listen to them and we get monthly updates. There is a Fed meeting this week. They're expected to pause the rates or keep them the same. We still are waiting for that rate drop, but like I said, it really hovers more on the Treasury note than what the Fed rate is. Over the last 30 years, the average mortgage rates typically been around 8.5%. We got a little bit spoiled during COVID when the government was trying to fund loans. They were lending out money to banks at 0% interest. So that left them an enormous amount of spread to capture. So when the bank was borrowing at 0% and lending to you at 3.5%, they were still making a full 3.5%. Typically, that spread between the mortgage rate and the consumer rate is around 1.75%. Over the last few years, they've had a little bit of a buffer in it, up to about 2.75%. So the banks really could lower rates a little bit, but since there's uncertainty in the markets, they like to have a little bit of a buffer, plus they like their profits. If you have more questions on how an interest rate could affect your purchasing power, please give us a call.